One of the most critical components of investing should be your investment philosophy, but it's something we often forget to think about. Welcome to The Pitch. I'm Sarah Allen, and today I'm joined by Anthony Kirkham from Western Asset Management. We're going to talk about his investment philosophy and how fundamental value is a critical component. Anthony, welcome. To begin with, how has your investment philosophy changed over your career, and how does it align with Western Asset Management?
Yeah, well, the good thing around that is that I've actually been at Western Asset or its predecessor for over 25 years. So my investment philosophy, probably started out very similar to what Western had as its base. It's an investment philosophy that Western's had for over 50 years. So they see it as time tested. And I would say it makes a lot of sense for what we do within fixed income. So it does have the components to it that really work in terms of investment philosophy. When you think about markets and trying to obviously add value for your clients, starting out with that long-term fundamental value is a really key starting point for our philosophy. Obviously, looking at and valuing and looking for mispriced securities is a really key component of that, and looking long term is obviously key and makes sense within a fund management firm like ours. With that though, of course, and it's the other side to our investment philosophy, is that you're not always going to be right. We'd love to be, but the reality is it's not going to happen. And so therefore, we must have, multiple and diversified strategies as a part of our positioning. And so thinking about those, how all your different positions are leaning, understanding that they could be leaning the same way in different economic environments is really sort of key to that investment philosophy. And so therefore, we really try and make sure that we do have them diversified, so that if we do get our view wrong, that it doesn't mean that our performance is going to be totally impacted as a result. So that's really the key components of it.
You mentioned systematically identifying mispricing.
Yeah.
What does this mean in practice, and how do you go about it?
Yeah, I think, as a fundamental firm, we do have, deep teams in terms of analysis. In fact, if you look at our analytical team, it is one of the largest buy-side teams in the market. They generally are definitely career analysts, so they're not trying to become PMs, they're career analysts looking at markets and looking at different sectors and obviously down to individual securities. And it's the same for the portfolio management team. We're thinking about those opportunities and trying to put it together in a way that, as I said, is somewhat diversified. We do have a number of tools that we use as well. So we've developed different models just to really highlight when we believe markets or securities are mispriced or sectors are mispriced, and that sort of makes our job a bit easier in terms of finding those. But then you've got to evaluate those as well, and so that's where you really do rely on those deep teams to look at those sectors, look at the industries, and then obviously look at the individual names to have an understanding of where that valuation might be.
What factors are behind these mispricings, and what's your view on them at the moment?
I think that particularly in the Australian bond market, which typically would just be made up of investors similar to ourselves or insurance companies, our market grew a lot because government debt grew. It meant that you actually were open to the world to invest into it. And so therefore you've got a lot of different investors coming to our market for different reasons. And so, we've found that those participants will be looking at different parts of the yield curve or different sectors within it. And because they're generally large players, they can sort of certainly move securities out of line or move sectors out of line. And we've definitely seen that over the years. And so therefore finding where that, is, or that sector or that security is mispriced, as on that basis that they're looking at it from a different objective. So my example there would be, you think about a Japanese insurance company tend to sort of look a bit more long-term, they're 10-year focused. And if they're investing a reasonable amount of capital into our market, then you can see that 10-year part of the curve can get mispriced. If they're, chasing semi-governments or SSAs or even corporates at different parts of the yield curve, then they do get somewhat mispriced. So it's about capturing those within the tools that we have to see where that valuation is out of line and therefore lean into those or lean out of them if it's looks expensive.
Where are you seeing mispricing today?
Probably a bit more sector-based. We've certainly seen some within, say, REITs is a good example. Pretty much post sort of 2022 as yields rose, valuations on REITs globally really got out of line because, some of them were too levered. Obviously, work habits changed, particularly on the office side. That probably drove some of that, I guess the change in those valuations. And so, therefore, basically REITs globally, sort of widening in spreads. But in Australia, when you look at our REIT sector relative to, say, the US, it's much more lower levered. So you have that. Generally, you'll find within those pools of assets, there's different levels of quality too. Often our prime A grade buildings are sitting inside those REITs, so they're larger corporations, better regulated, and therefore, as a result of being prime and A grade, even as people's habits around office change, people were actually still wanting to, obviously lease that space in prime and A grade buildings because they were, the best buildings, they were located in the best spots, and therefore, they actually performed reasonably well. I think the other component of that is that a lot of our REITs also have, are diversified in nature as well. So they're not just office. You've obviously got retail as a component, you've got industrial as a part of that, and all those have actually done reasonably well in this environment. So therefore, the pricing of them sort of got pushed wider as a result of what was happening offshore. But, for us, we could say, hey, these shouldn't be going wider. These are actually good performing assets. And so you lean into that sector, and we've seen those actually contract since. So yeah, there's definitely a bit of that. And we're still a bit overweight those, to be honest, because there's probably a little bit more to go in some of that, within some of those REITs.
Thank you for sharing your insights today.
My pleasure.
If you've enjoyed this interview, please subscribe to Livewire Markets. We're adding more great content every day. Thank you for watching.